You're kicking yourself for not investing in Netflix and that 6,000% return over the last decade. You sold out of your Amazon stock way too early, missing out on a tenfold return it's produced in the last 5 years. In this video, I'll show you how to find the next generation of FANG stocks, the companies that will change the world and could make you rich. I'll share the clues I look for in innovative companies and then reveal 7 stocks to buy that could produce returns of 10 times your money and more. We're talking the next FANG stocks today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, the returns on the FANG stocks have been unbelievable. That's Facebook, Apple, Netflix, and Google, and usually includes Amazon as well. Just looking at a chart of the returns over the last 10 years is physically painful, knowing you missed out on that kind of investment. The FANG stocks produced an annualized 37% return over that period, more than 5 times the 7% annual return on the stock market. Hell, even Google, with its miserable 377% return over the decade, was double the market return. A single $1,000 investment in Amazon in 2010 would now be worth over $22,000. That's the kind of investment that can fund your entire retirement in just 10 years. But you missed out, and when I say you, I mean me as well. It's technically impossible for these stocks to reproduce that same kind of return. For shares of Apple to increase another 1,300%, it would have to grow to a $26 trillion company, larger than the entire US economy. Put another way, at the current price-to-sales ratio for shares, Apple would have to make $3.7 trillion selling an iPhone to every single person on Earth. But we can learn from those FANG stocks. Look at how investors made those 10x returns, and that's what I want to show you in this video. I'm going to show you the sectors and the industries most likely to grow into that next generation of FANG stocks. We'll look at some clues to finding the next stocks to buy. Then I'm going to reveal the 7 stocks to watch for those tenfold returns over the next decade. Now understand, I'm not saying that these FANGs are going to be bad investments over the next 10 years. I own shares of Amazon and Google, and all 5 of these companies are dominating their market. But if you want those quadruple-digit returns, it's not going to be in these names. Bagging 10 times your money means being ahead of the game and finding that next generation. So I want to jump right into that next generation of FANG stocks, and just working through this list is going to give you an idea of where to find them. First up is $3.1 billion Pluralsight, ticker PS, an AI-driven skills development platform that touches a lot of the developing trends. The company runs a skills development platform for online courses in the tech area, subjects like cloud, security, and data. Everything a business needs, and the beauty of this is that proprietary machine learning assessment tool that helps businesses know which skills their employees need to work on. So when we talk about those themes and the industries to follow, you're going to see a lot of the Pluralsight in here. We've got an algorithmic-based functionality. We've also got online skills development, which is obviously hugely important right now, and an addressable market that gives the company a runway for growth for decades of growth. Pluralsight booked $317 million in revenue last year, an increase of 35% over the prior year, which in turn was 39% growth over the year before that. Now that's still just a fraction of the $42 billion market for the business technical skills development and the $300 billion plus for global e-learning market. Giving me even more confidence in this company is the fact that growth in the large customer segment has increased. Pluralsight has grown customer accounts in the million-plus billing segment 122% over the last 3 years. The company has a solid balance sheet with over $406 million in cash against $567 million in debt, so that financial survivability that we like to see, and very nearly cash flow positive. Next here is $2.3 billion Stitch Fix, ticker SFIX, and more of that consumer retail idea, but with a disruptor twist. Stitch Fix is an online fashion service that touches a lot of those disruptor ideas that we'll talk about. It's an online retail service, which we know is bringing in billions of dollars from that traditional brick and mortar model every single year. The company estimates the online apparel market at over $111 billion in the US and the UK alone, and that's just a quarter of the total market. Online sales are expected to grow by 13% a year to over $200 billion by 2024. Stitch Fix isn't a retailer though. It's using a data-driven algorithm and that human intuition to help match people with their perfect look. Customers create a profile that assesses their preferences and then matches them with a stylist. Then it powers those retail services and delivers the product. The company booked 18% client growth last year and 2 consecutive years of 25% plus revenue growth. So not only are you growing the client base, but making more money per client. The company reported a 9% increase in active clients to $3.4 million in that March through May quarter. And while net revenue was down slightly to $371 million, it was a great quarter considering the broader apparel and accessories market saw sales fall as much as 80% over the period. Definitely, this one is the kind of disruptive technology that we're looking for. So you see in these first two picks and the ones that we've got coming up, we're going to be sticking with those two sectors of the economy, technology and communication services. Now that's not to say that we won't have high return stocks in those other sectors, but the margins and the growth is clearly in this IT and connectivity. Within these two sectors, we also want to be focusing on a group of industries, those with the most potential for that disruption and innovation. Here we're talking about industries like DNA sequencing, robotics and AI, healthcare IT, the Internet of Things, and augmented reality. Now, a lot of these have gotten a boost from that new lockdown reality, so don't expect any of these stocks to be cheap. Amazon reported earnings of just $1.25 per share in 2015, while the stock price was trading at upwards of 500 times that. So this definitely isn't going to be a bet for your value investors. But just like those shares of Amazon that has surged 600% in the last 5 years, if you get that growth behind these disruptive technologies, they can just keep on rising, even from those higher PE ratios that you'll see. CRISPR Therapeutics, ticker CRSP, is a $7 billion gene editing company that, as an old man, I'm definitely interested in seeing what they can do. Nation, in the 100 years to 1900, the average life expectancy in America barely budged, adding less than 10 years onto the average person's lifespan. In the 100 years to 2000, it almost doubled to 80 years old. We have seen the power of biotech in not just prolonging life, but the quality of life, and we want more. CRISPR uses patented technology enabling directed changes to genomic DNA, technology that could someday allow us to remove the parts of our genes causing cancer, diabetes, or even turning back the clock. The company has a strong pipeline, including collaborations and wholly owned techniques, 5 of which are just one step from being marketed products. This is moonshot stuff, and CRISPR is the leader in the space. Now, there isn't much there for revenue or earnings as you'd expect from an early stage biotech, but the company has $945 million in balance sheet cash and just $50 million in debt, so a pristine balance sheet and all the cash it needs to get some of that research through to sales. Those of you in the Bowtie Nation are going to recognize this one, $9 billion Fastly, ticker FSLY. I first recommended Fastly back in November and then again in March when it hit $11 a share. It surged to $109 per share before giving up about 30% after it disclosed that TikTok as its biggest customer for about 12% of revenue. This is an opportunity to pick up more shares, even after that 800% return that we've booked since March. Fastly operates a cloud platform for content delivery, which is just a fancy way of saying it helps websites and the internet to you faster. It also provides streaming and video services, which puts it right in the middle of the biggest themes in the internet and media, and a $35 billion market opportunity from its 2 segments. And while that quarterly earnings report sent the shares lower, there was still a lot to like here. The company swung to a net profit, which is always great proof of the business. Revenue jumped 62% from the prior year to $75 million, and it's expected to match that in the third quarter. Analysts are expecting full-year revenue around $297 million this year and to double to $614 million by 2023. The company's revenue retention rate is an amazing 99.3%, and not only are customers sticking around, they're also spending more with 133% growth in that expansion rate in the first quarter. Now, is this stock still expensive at 48 times on that price-to-sales basis? Yeah, but you don't get that kind of growth and a key disruptive market for cheap. I've owned these shares since November and will pick up more after this sell-off. Next here, Medallia, ticker MDLA, is a $4.4 billion AI-driven software-as-a-service platform that's deep into the biggest changes in tech. Medallia runs a cloud service that captures experience data from employees and customers. It's AI-driven software that collects the data across human, digital, and Internet of Things devices, then analyzes it for that business insight and marketing. And Nation, I know a lot of this tech jargon probably doesn't mean much, but one of the biggest trends over the last several years is just the collection and the use of that data. What you do online and how companies can use that data to sell more efficiently, to create targeted products, and to be more profitable. Medallia goes beyond what we've seen with others in the space though, with its AI-driven software and a connection with that Internet of Things theme as well. The company grew customer count by nearly 40% over the last year and is quickly approaching that point where they become a go-to name in the industry. Revenue has grown by 20% plus over the last 2 years and is expected to reach $549 million by 2022. Not only does Medallia continue to grow revenue by that double-digit rate, but it's becoming more efficient as well. The operating margin improved from a negative 15% last year to just 1% shy of break even this year. So another company on the edge of profitability. We've still got 2 more next-gen FANG stocks to share, but some other factors that you want to watch for when looking at these next-generation stocks. You want to screen for small cap companies, so those with the market size under $3 billion or at least under $10 billion. Now I know that Apple and Facebook have been the exception here, but you're really fighting against the law of large numbers. It's much easier for a $5 billion company to grow into that $50 billion giant than it is for something like a $230 billion Disney to become a $2 trillion company. We're also looking for disruptive technologies and competitive advantages in this space. I know this one is kind of vague, but you're going to be reading through those company descriptions and you'll get an idea pretty quickly about which are changing their industry, which have that first mover advantage in the product that everyone is going to want. I'm also going to want to focus on the companies in the consumer side of sales, those selling directly to the consumer market. Of course, there are a lot of companies on that B2B side, the business to business side, that are making a ton of money. Salesforce.com is a great example, but just the scale of the consumer market, that $15 trillion in consumer spending in the United States alone, we're much likely to find our next hot stock in B2C, in business to consumer. And just looking at the FANGs, that's largely been the case. Facebook and Google book some of their revenue from business advertising, but for the most part, all 5 of these stocks are in that consumer or retail side of the market. I'm going to break my rule with these next 2 though and go a little bit larger with $15 billion web development company Wix, ticker WIX. Wix markets a cloud-based platform that enables anyone to create a website or an application and then upsells a suite of 20 plus features to automate and grow your business. The company sells internationally with 55% of its revenue from North American customers, but double-digit growth in every geography. The company did report mixed earnings for the second quarter, with revenue beating expectations for 27% year-over-year growth to $236 million, though earnings did miss on an increase in marketing expenses. Their shares initially dropped as much as 13% on the news, but then closed down just 0.5%, which is a great confirmation of the price. Whenever one of these high-flying stocks can take a relatively bad earnings report and not tumble, that's a sign of investor commitment and the long-term outlook in these shares. Wix has been growing revenue consistently around 26% a year and confirmed its target for 2020. User growth continued to surprise, up 18% in the most recent quarter, and the company is making more on each subscription, growing an average revenue at 6.5% annual rate. Analysts expect revenue to grow to $1.5 billion by 2022, more than double the 2019 sales, and the company is building up its e-commerce features to take on $130 billion Shopify for those website owners. The world is going online. There are more than 500,000 new websites created every single day, and Wix is positioned right in front of it. Another large company here, $37 billion communications development platform Twilio, ticker TWLO. Developers and companies use Twilio's platform to create text, voice, and video communication with their customers. In a disconnected, locked-down world, across tech channels is the only communication some companies have available, and Twilio added another 20,000 customers last quarter after nearly tripling its customer base last year. The company had a blowout quarter, growing revenue by 46% and booking 132% growth in that net expansion rate. That means besides customer growth, clients are also buying more services once they sign on. COVID is accelerating that trend to digital communications, and clients include financial services giant ING, Deliveroo, and the American Red Cross. Analysts expect revenue to reach $2 billion by next year, and the company has a surprisingly strong balance sheet with $1.9 billion in cash against just $695 million in debt, so cash positive and producing $150 million in free cash flow annually. Click on the video to the right for the undiscovered penny stocks that could surge higher. 7 penny stocks to watch that could make you rich. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.